subject to manipulation. But there doesn't have to be manipulation. That makes it worse. Just human nature, a rumor, an actual failure, and all of a sudden it's you don't trust anybody. You're getting all your money out of all the banks. And again, this is actually a regulator's worst fear. Stock market crash is pretty bad.
Jim Rickards has a truly dire warning about all Americans could be on the verge of losing their money thanks to a possible oncoming nationwide bank failure.
I started my career at Citibank at a time when there was a strict, Glass-Steagall divided commercial banking and investment banking. That's all gone. They're all mushed up, but they could be in the same institution, whether it's Citi or Morgan Stanley or Goldman or Wells Fargo, et cetera. But they are different activities. So looking at the banking system, what's the equivalent of a market meltdown? What's a run on the bank? And again, we've all seen the grainy black and white photos of the 1930s. Banks are failing, and mostly men. Some women are in overcoats and fedoras lined up around the block in the rain, trying to get in the door and get their money out before the bank shuts their doors. And usually you didn't make it because the insiders had already taken their money. So that's a good old-fashioned run on the bank. Today, the same phenomenon, the same dynamic applies, except you just get your iPhone and move $1 billion with a couple passwords. Boom, it's out. And you text your friends in the process, which is exactly what happened with Silicon Valley Bank. I mean, that didn't work out over weeks and months. I mean, that happened in 2 days. $100 billion went out the door.
Assume there is a rumor of a bank failing, or that a failure occurs and people begin to panic. They no longer trust anyone, so they hurry to withdraw all of their money from the banks. This type of activity is a regulator's worst fear. If you extend this concept to the capital markets, the situation becomes comparable. Consider a market crash occurring, possibly triggered by AI, but that's a whole other discussion. AI can be employed by spy agencies, market manipulators, and other negative actors to create or hasten a disaster. However, for the time being, let us imagine that a crash has occurred. What do most individuals do when the market collapses? If they've gone through enough crashes recently, they'll sell everything, move to cash, get out of the mess, and wait things out. Once the dust has settled, they may carefully re-enter the market, purchasing equities that appear to be bargains. Then, once the market recovers, they return to action. This is an intelligent strategy for an individual. But what happens if everyone adopts that strategy? Suddenly, you have a market full of sellers but no buyers. What happens then? The market begins to plummet quickly. You blow past circuit breakers, which are supposed to prevent trading when conditions become too chaotic, and in the worst-case scenario, markets may even close entirely.
So it comes a time when the circuit breakers don't work, the losses are too great, we're talking multiple trillions of dollars of losses, the panic is too embedded, there are no specialists, there are no kind of Whitneys to walk around the floor and say, I'll buy some, because we've handed it over to AI, and AI has no common sense. It has algorithms, but that's it. And the other point I make is that as humans, we tend to anthropomorphize our system. So I'm sure we've all had encounters with Siri and Alexa, and there are others. Google has one, they talk to us, actually a pretty pleasant voice. And so you almost develop a friendship with your computer. It's like, hey Jim, what do you want? What do you want the lights to be? Or dim them down a little bit or turn them up. Or you're talking to this computer, but we tend to think of them as humans. They're not. They may have pleasant sounding synthetic voices. It's pure math. When you know how it works and you dig in, it's just math and a huge database. So they're not our friends. They're not human. They're actually not intelligent. We call it artificial intelligence. The artificial part's true. They're not really intelligent in the way that humans are.
So what is the solution? Human nature is a contributing factor to the situation. But here's where things get tricky. AI is now amplifying and accelerating human nature. Panics are not new. They have been happening for ages. For example, in the 14th century, the Bardi and Peruzzi banking families in Florence failed. Panics are not new. What is new is the rapidity with which they can occur now. AI generates a feedback loop which amplifies the issue and accelerates everything. You might be wondering, can't we design AI to mimic humans? Some individuals see a market decrease and say, hey, maybe it's a good time to start buying. The problem is that the algorithms don't work that way. To construct these systems, you must bring together technologists, scientists, and market actors. However, most AI utilized in markets is not as nuanced. They all function similarly. It would be wonderful to believe that your algorithm is smarter than someone else's, yet they are largely based on the same ideas. Jim knows this since he has created these systems himself. He has worked on them for both the United States intelligence community and the finance markets. These algorithms use information from a variety of sources, including business school, Wall Street, and market experience. How to optimize trading in capital markets is based on a complex mathematical theory. But here's the kicker. If everyone uses the same tactics and algorithms, all programs will behave similarly. On the New York Stock Exchange, there used to be something called a specialist. These experts have the advantage of establishing the market in specific stocks. They were the market makers. They could see behind the scenes and had certain advantages, but they also had obligations. Their responsibility was to assist balance the market. If there was a rush of sellers, they were meant to jump in and buy to keep the market stable. If there was a stampede of purchasers, they would sell to maintain the market stable. That system is long gone.
And so we're anthropomorphizing it. We're treating them as friends. We're treating them like humans. We're relying on it. It is very powerful. I don't doubt that. And again, to my point, it's not that it's going to malfunction. It's going to work exactly as intended, but most people don't understand what that means.
I can absolutely. I think I agree with you that AI is not as intelligent as many people perceive it is. It has huge limitations. It can't compete with all the amazing intelligence that humans have. I also agree that there's a risk to if everything is controlled by AI, especially in the financial markets, that this could lead to crashes and other things, especially when they're manipulated. So beyond those, what other challenges do you see that AI in the financial world brings? What are some of the other examples?
Well, we just talked about capital markets and stock markets, and that is the danger. And again, I make the point, and you said the same thing, Bernard, that panics can happen on their own for no particular reason. When they happen, you look back and say, well, it was this or that fund or whatever, but that's more of a symptom than a cause. They just kind of fall in on themselves, and AI will amplify that. But when you combine it with market manipulation, someone who's very sophisticated in AI, who understands what we're talking about. And
Jim visited with stock exchange officials who told him unequivocally that there is no actual liquidity on the trading floor anymore. We now have computers and artificial intelligence, AI. However, these systems lack the common sense human role of intervening to maintain market equilibrium. So when a sell-off begins, AI adheres to its training. The algorithms all cry, sell, sell, sell. And if there are no buyers, the market plummets. We trip the circuit breakers and shut everything down for 15 minutes. But if the panic continues, it will trip the next circuit breaker. At a certain point, the losses become so great that even circuit breakers can't stop the free fall. You're looking at trillions of dollars in losses. In a full-blown panic, there are no specialists stepping in to buy. We've handed control over to AI, which doesn't have common sense. It just follows algorithms. One of the big problems is that we humans tend to anthropomorphize our technology. Take Siri or Alexa, for example. They talk to us in pleasant voices, and we start to feel like they're our friends. We think of them as being more human than they really are. But here's the reality. They're not human. They don't think like we do. It's all math and data. AI isn't actually intelligent in the way humans are. We call it artificial intelligence. But really, it's just artificial. The danger with AI in the financial markets is that it will work exactly as it's programmed to, but most people don't realize what that actually means. AI amplifies market dynamics, especially when things are going bad. It can take a regular market panic, something that might normally work itself out, and turn it into a full-blown crisis, and that's just when it happens on its own. Now imagine someone actively manipulating the market using AI. Market manipulation has always existed, but AI takes it to a new level. A sophisticated player, someone who understands AI and how to manipulate markets, could use these tools for criminal purposes. They could trigger a market panic, profit from it, and walk away before anyone realizes what happened.
Got it. I'm not going to take that and use it to my advantage in criminal or manipulative ways, and then leaving aside the greed factor, people trying to cause a market panic, but front run the panic in a way that they make a lot of money and just get away with it. They're also, again, it's a weapon. We don't have to necessarily spend a lot of time on financial warfare. I facilitated the first ever financial war game done by the Pentagon. They did not need my help with missiles and bombs and things like that, but I was tapped as a financial capital markets expert to help design a financial war game, and we did. This is before AI has been around since the 50s, or you can go back to Aristotle if you want to. But we worked at a weapons laboratory between Baltimore and Washington and did that. So I have a lot of experience in financial warfare. But when you say, well, it's not just market manipulators, but intelligence services and political enemies who are trying to do us harm.
On top of that, you have to consider financial warfare. Jim helped the Pentagon run financial war games. These are exercises where we simulate attacks on the financial system. The idea is, in the past, wars involved bombing infrastructure, factories, railways, pipelines, to cripple an enemy's economy. But now you don't need bombs. You can destabilize an entire economy through digital means, like manipulating financial markets. So if someone wanted to cause harm, they wouldn't need to drop bombs. They could just use AI to crash the market. Combine AI, market manipulation, and bad actors, and you have a very dangerous mix. Jim doesn't think we should get rid of AI, but we need to be aware of these risks. There are solutions out there, and he talks about them in my books, but the first step is understanding the dangers. This doesn't just apply to capital markets either. It's something that could also impact the banking system. But that's a whole other topic. Back in the day, there was a clear line between commercial banking and investment banking, thanks to regulations like the Glass-Steagall Act. But that separation is gone now, and the big financial firms, like Citibank, Morgan Stanley, Goldman Sachs, Wells Fargo, and others, often handle both sides of the business. Even though they might be part of the same institution, they engage in very different activities. When it comes to the banking system, we have to ask, what's the modern equivalent of a market meltdown or a run on the bank? We've all seen those old black and white photos from the 1930s of people lining up around the block, in the rain, wearing overcoats and fedoras, trying to get their money out of failing banks. Typically, they didn't make it in time because insiders had already pulled out their funds. Today, the dynamics are the same, but the process is much faster. Now, you don't need to physically stand in line to withdraw your money. With a smartphone and a few clicks, you can move billions of dollars in seconds. This is exactly what happened with Silicon Valley Bank, SVB. That wasn't a slow-moving disaster. It unfolded in just 2 days. $100 billion flew out the door, and it wasn't just small depositors. Over 95% of the deposits at SVB weren't insured by the FDIC, which only covers deposits up to $250,000. The big withdrawals came from major firms and even crypto exchanges that had billions in dollar balances with SVB. And the panic spread fast. People were texting each other, warning them to pull their money out too. This kind of instant communication combined with AI sped up the bank run so much that regulators were among the last to find out what was happening. By the time they could react, most of the damage was done. In fact, now corporations are doing something truly sinister.
Now you almost don't even have to do the prompt injection to steer the result in the way you think is desirable, even if it's false. The content is so biased the other way, not racism and anti-Semitism, but actually it would have a bias in favor of anti-Semitism if you want to use recent events as a baseline, that you almost don't have to use prompt injection because there's been so much brainwashing and propaganda that the training set, again, the computer doesn't know any better, it just reads all this stuff and correlates it. The training set itself is heavily biased in the opposite direction of the biases that Silicon Valley finds repugnant. And my answer, and the answer of others, because I've spoken to other people about this, is leave it alone. Don't scrub it. See what it is. Don't don't turn a blind eye to bad things, but be enough of a mature intellectual, a fact-based person, a person who can do his or her own filtering. You don't need computers to do it for you, and let it be, and get good results, get good factual results. My point is that, so who are the gatekeepers on AI GPT? Who are the gatekeepers? It's Facebook, Google, OpenAI, not a public company, but they're big in this, and Microsoft, and a few others. Who are they? These are the same people who lied to you about COVID, told you the vaccines work. They don't work. They're not vaccines. Pfizer and Moderna made. Those are experimental gene modification treatments.
This situation, accelerated by digital tools and AI, is a regulator's worst fear. Stock market crashes are bad, but they are somewhat manageable. You can recover, even though it's expensive and disruptive. But with banks, it's a different story. Banks actually create money, not the Fed. The common idea that the Fed is printing all the money isn't entirely accurate. Yes, the Fed creates a specific type of money called base money by buying bonds. However, the real money driving the economy comes from banks. So when banks start collapsing, it's a much bigger problem. When banks fail in a chain reaction, that's the Federal Reserve's worst nightmare. It's not just about losses in the stock market anymore. It's about the potential collapse of the entire banking system. The only solution to that kind of crisis is to nationalize the banks, and that's a drastic measure. What's different today compared to past crises is the role AI plays. The market dynamics haven't changed much, but AI amplifies and accelerates everything. AI lacks the human judgment to distinguish between a healthy and a failing bank. It just executes its programming, which often means selling off everything in a panic. This lack of nuance makes financial crises unfold much faster than before. Jim has researched this in great detail, and while he's not saying we should get rid of AI, it's important to understand that it works too well. The problem is not that AI fails, it's that it does exactly what it's designed to do. But the unintended consequences, like amplifying market panic, are what developers often can't foresee.
Actually, I make the point, it's almost never the case that it doesn't work. It actually works exactly as it's intended. It works very well. But the problem is the things that the developers can't see. Unintended consequences is one way to think about it, but on a sort of broader plane, things that make sense for an individual bank or an individual hedge fund or an individual application, etc., might be extremely dangerous when scaled up to include all the players on the scene. This is something, the idea, goes back to, any banking panic.
There's a concept in economics called the fallacy of composition, which means that what makes sense for one person doesn't always work when everyone does it. A simple example, imagine you're at a baseball game and one person stands up to get a better view. It works for them, but if everyone stands up, nobody has a better view anymore, and now everyone's just uncomfortable. The same applies to financial markets. When an individual investor sells off everything in a market crash, it might be a smart move. But when everyone does it, the market can collapse entirely. This is why AI, digital communication, and our own human tendencies can make modern financial systems more fragile than ever before. In today's world, the speed of AI and instant communication means that financial contagion can spread faster than regulators can respond, making crashes and bank runs more dangerous than they've ever been. Do you think Jim is right about this? Let us know in the comments below.